Just some data from Preqin. We actually ask investors a few times a year, institutional investors, and we survey them on their perspective on how accurately they believe managers are valuing portfolios. In 2022, 65% of the investors in our survey believed that portfolio companies were significantly overvalued. In 2023, that proportion dropped to 45% of investors, so indicating a more confident outlook. Now, the current climate that we're in, the transaction activity still remains muted. The number of transactions we saw in Q3 of this year is down 20% from Q3 of 2023 and 45% lower than the peak in 2021. Our data also shows a slowdown in exit activity, particularly for vintage 2015 funds, resulting in a backlog of unrealized investments. And what we're predicting is that the pent-up supply may lead to a significant influx of assets in 2025 entering the market, and that could impact valuations. So what signals do you believe could effectively unlock the stalled deal flow in the market? And what types of transactions, both entries and exits, do you anticipate will emerge as leaders in the first 6 to 12 months following a deal resurgence? Michael?
So in the technology space, more so than pretty much any category of this matters for valuing any company, growth is a material impact on how you would value a company. So if you think about what was happening from 19 to 21, the ZIRP era basically masqueraded a lot of growth. There was a lot of free money out there that was flowing through to a bunch of companies, everywhere from software is a kind of enterprise software is a huge example. So when these companies are growing extremely fast, everyone's excited for what the opportunity can be and is willing to pay up because the time to actually grow into that valuation theoretically is relatively small. When the growth stops and these companies are well capitalized, and make matters worse, a lot of these founders took a lot of secondary sales to line their own pockets. The need for liquidity or need for an exit basically doesn't exist. Who wants to force the exit? The founder, who's going to have to fire all their employees and get nothing for it. The investors, who are going to have to mark down their books and go to explain to their LPs why this company is worth less than what they paid for it 6 months ago. So ultimately, what happens is these companies are afforded time to grow out, and we're starting to see opportunities there. And I think to your question about where the exits come from, the companies that actually were able to maintain or reignite that growth. And there are probably a handful of 5 to 15 companies that, if I mention the technologies companies' names, everyone would recognize already, have already been kind of soft prepping for an IPO. I don't think that that is necessarily the end-all, be-all for all of these companies, because a lot of the companies that had raised in a time frame will never hit the growth rates required to hit those valuations. And then you have continuation vehicles, other forms of liquidity, or eventually, the zombie company that just functions because they don't know what else to do with themselves.
Yeah, I think growth is absolutely critical to that story. I think as growth investors ourselves, obviously what we're looking for is to generate our returns when companies have top line growth. And I think the way that we've focused on that is really in our market, in our segment, the strategic sale is the critical exit path for us. It's by far the majority. And that presents kind of two very interesting subjects. One is that we're less dependent upon the market multiples and cycles. We're less dependent upon an IPO cycle, but we're more dependent upon our companies actually executing two things. One is actual top line growth and market fit. And I think that's kind of what these things unlock that way first, right? Instead of just like broadly, oh, now everybody's going to go public or everybody's going to get acquired. It's going to be the companies that execute that best first will have that best opportunity and more of it. And I think that's in our market, that's just kind of the dynamic that we focus. And the other one is just simply scale. When we make investments, the companies are in that kind of smaller stage, and so the same amount of growth rate leads you to an exit valuation that is more acceptable to acquirers. So selling a company for $300 to $500 million is a lot easier than selling one for $2 billion, almost no matter what it does. And so I think that you see that kind of start in those shifts, and that those parts I think probably come first.
Yeah, we're seeing the mid-market strength as well.
No, I was going to say I can't let a valuation question go unanswered by what the secondaries market observes on valuation, because when you think about secondaries, the first thing people think about is, okay, what is a discount that I'm buying these private markets asset at? And that discount is really a reflection of, your point about confidence in the underlying GP's valuation. So just, again, this is sort of generalization, but when we think about the buyout asset class, typical discounts these days are in the 5 to 10% range. So, 90 to 95 cents of underlying GP valuation. On the growth side, that discount widens and it's a bigger range, maybe in the 20 to 30% discount. And then when we're looking at a venture capital fund, it widens even further, maybe in the 30 to 50% discount. So the type of assets that end up trading on the secondaries market, I think, is a reflection of the views, the confidence of the underlying GP's valuation. So that's point number one I want to add. Point number two, I think the previous comment is really about growth. If you remember, if you go back sort of right after COVID and you think about what happened to just US companies in general across buyout, growth, and venture, you first had inflation, which compressed margins. And then interest rates started to rise, which means companies then ran out of cash. And then I think when you think about last year, we're starting to see some slowdown in top line growth. So no matter what type of company you are, you have these three factors that are impacting your ability to use cash to grow, either through acquisitions or just kind of reinvestment back into your company, into your capex. And you have now a potential slowdown in growth. And I think the latest macro forecast from BlackRock in the market is the U.S. economy is somewhat still resilient, but there's undoubtedly a bit of a slowdown in growth. And so I think it'll be interesting to see how valuations of the underlying GPs evolve to reflect these three factors that has now crept into the ecosystem that is impacting financial performance. And whether you're talking about an exit through an IPO, an exit to a strategic, there's also a third path, obviously, which is exit to another sponsor. I think there are a lot of growth companies that get bought out by the next large growth investor, the next larger fund. And then obviously now you have continuation vehicles and sort of LPs driving some of that distribution. So I think it's a fascinating valuation of the underlying GPs and what it ultimately trades at on the secondaries market is sort of a fascinating trend and topic to observe over time.
I just want to add one thing on top of that. So you're starting to see segmented markets where others on the panel focus and where I focus, and where I'm focusing is still on the venture growth. And a lot of this baggage that exists with these companies is something that, quite frankly, I don't want to deal with. Right? There are other people on this panel better suited to deal with the structuring and restructuring of these companies to make sure that they continue to survive and make somebody money along the way. That's why a lot of the focus for me and a lot of the other people in venture are around artificial intelligence, because a lot of these companies have been started in the last 3 to 5 years. They haven't had to deal with some of these hurdles and are running straight towards a growth market where, so this was said to me early on in my investment career, try to invest in something that can touch as many areas as possible. And there is not a thing that you can think of that AI will not touch in some way, shape, or fashion. So it's a question of how broad can you go and how focused you have to get. And there's obviously different strategies to kind of capitalize on that. But the reason that you're hearing about AI funding in the news, especially on the venture side, is because a lot of these companies are unencumbered with all this other legacy baggage from raising at valuations that no longer make sense in 19, 20, and 21.